slowly start going. Exactly 4 o'clock. Welcome on behalf of CFA Society VBA Netherlands to this workshop for level 1 CFA candidates. It's the first workshop this week. We have tomorrow for level 2 a workshop and the day after tomorrow level 3, and Jonathan will be the teacher tomorrow as well for the level 2. CFA Society VBA Netherlands is the Dutch chapter of CFA Institute. So we are the society in the Netherlands for investment professionals. We have over 2,000 members, 2,100, and we also have candidate members. So if you're interested in joining us as a member or a candidate, you're most welcome. But I can imagine that first your focus is on the level 1 exam. For this time, we picked the topic of derivatives, which in practice turns out to be, a bit of a challenge for students in both level 1 and level 2. So that's why we have a focus on this in this session. We have organized a lot of sessions already in the past with Jonathan Boon. Normally we would do this live in person, but the whole world has become a bit more virtual. So we're very happy that we can organize this through a webinar. And we're very happy to have Jonathan Boon of Kaplan here to do to talk you through the derivatives. So without further ado, I would like to give the floor to Jonathan.
Fantastic. Thank you so much for that. Welcome. So the idea is this will be about an hour and a half to 2 hours run through level 1 derivatives. Typically, if you've got questions, generally it's easier to leave them till the end, and I'll do a Q&A at the end for anything that you wanted to ask essentially during the presentation. If you fire questions at me whilst I'm doing the presentation, well, men can't multitask and I'll get lost somehow. Okay, you've got my email address there, and hopefully you received a link to this presentation as well from the Netherlands Society. They sent it out, so you should have these slides available to you. You've got my email address there as well. Please feel free that you can reach out as well via the email if there's any questions that you would like to ask. Fantastic, so let's get going on this. My background is obviously I'm a CFA charter holder. I'm also an ACA, so a chartered accountant in the UK. Not that I've done that for 30 years or so, but I do have the qualification. And I actually head up the product at Swayzer, Kaplan Swayzer, so in charge of all of those books and QBanks, etc. that I'm sure many of you use. Fantastic, let's get going then into our presentation. If I can get my slides to move, let's just get my cursor back from the other screen. There we go. Right, so first things we're talking about here is a forward contract. So key point with these are they are contracts. In other words, once you've entered it, you legally have to go through with it. Okay, now it does say over the counter, OTC. That essentially means there is no centralized clearinghouse, which means there is counterparty risk in these products. In other words, if one party defaults, that can create a loss for another counterparty. But because they're over the counter, they can be customized in terms of delivery dates, in terms of quantity, and in terms of quality of the underlying asset. So if you wanted to hedge a risk, you might have a very specific risk, and often it's easier to do that with forward contracts because you can tailor the contract to your precise conditions. Now, what that does mean is typically your counterparty in these transactions will be a bank. The bank will form or create the contract and you'll be their counterparty. So let's have a look at features. It says predetermined price. That is known as the forward price. We also talk about futures contracts. Only difference with them and forwards is, of course, futures are exchange traded. So the predetermined price. Now, key point with your predetermined price is you do not pay it up front. So you don't pay it when you enter the contract. Instead, you're going to pay that predetermined forward price on delivery of the underlying asset. So our features that we have are a predetermined forward price, specific asset, so an asset that's either being bought or sold, and it's for a future settlement date. So delivery is not taking place at the current point in time, but delivery will be at a future date. And that takes us to the parties here. So we have two parties in every futures contract, a long and a short party. And as I said, one of them is likely to be a commercial counterparty, and the other one is likely to be a bank that is creating these forward contracts. And like with every other transaction a bank enters into, they're trying to make their profits on a bid-ask spread. Now notice our long party here. So we talk about long and short. The long party is the party that is agreeing to buy the underlying asset. But remember, they're not buying it today. They're actually buying it in the future. But what they're doing is locking in today to a guaranteed purchase price. And that is that predetermined price that we mentioned before. So the long party is agreeing to buy an asset in the future and pay a price determined today. So that's our long. And for every long, there's got to be a short. So this party is just agreeing to do the opposite. They're agreeing to sell the asset for a predetermined price at a future date. Now, as you can see, we've said they're exposed to counterparty risk. If one party defaults, and of course, normally it'll be the party that is losing on the contract, then the other party is likely to make a loss. Now, if you think about it, if from the long party's point of view, if you're locking into a guaranteed purchase price to pay in the future to receive the underlying asset, you're going to make profit when the underlying asset price rises over time. Okay, because you've locked into a guaranteed purchase price. So if the purchase price rises over time and the underlying asset is worth more than your guaranteed purchase price, well, hey, you've made a profit. So the long party is really taking a kind of bullish position on the underlying asset. Bulls and bears, if you ever get worried about those, you just have to remember how the animal attacks you. A bull attacks in an upward motion with its horns, and therefore, when we talk about bullish, we're talking about prices rising. Bears attack with a downward motion with their paws, and therefore, when we talk about a bear market, we're talking about prices falling. So, long party, therefore, because they've locked into a guaranteed purchase price to be paid in the future, they are hoping that the underlying asset rises over time. So they're hoping for a bullish market. Now, of course, the short party is hoping for exactly the opposite. If the underlying asset rises over time, that's bad news for the short party because they're selling that underlying asset at a fixed price, and that fixed price might now be below the underlying asset's actual price in the future. So the short is taking a bearish position. Ideally, therefore, they want the underlying asset to fall over time. So therefore, what they sell the asset for, and when they sell the asset, they receive that predetermined price, the forward price. Hopefully, that is above the underlying asset's price at maturity. So there's our participants, as we mentioned. End users could be corporations, could be governments, but typically we're talking about people seeking to hedge an existing risk. So forward contracts aren't massively used for speculation. You can use forward contracts to speculate on the value of an underlying asset, but they're a little bit clunky. And they're a little bit clunky and unwieldy because essentially it's not a liquid market. Because each forward contract is unique. Remember, the predetermined price, the specified asset, the future settlement date, the quality of the underlying asset, the quantity of the underlying asset. It means every forward contract is slightly different, and therefore the market is not hugely liquid. And that means it's very difficult to close your position out. Now, in derivatives, you close your position out by doing equal and opposite. So initially, if you go long, you're agreeing to buy an underlying asset. So you can close that position out before delivery by going short a forward contract and agreeing to sell the underlying asset. So due to the lack of liquidity in forward markets, it makes that rather difficult. Okay, so therefore it's typically going to be dominated by people wanting to hedge an existing risk, and the other side is going to be a dealer, a bank. They're creating forward contracts and trying to profit on the bid-ask spread. Now, CFA Institute rather expect you to understand hedging using derivatives, but they never really set it out in the books. They don't mention how to do it at level 1, and they don't really mention how to do it at level 2. It's just assumed knowledge. I tend to find with derivatives, you tend to find people are in two schools with derivatives. Those that have encountered them before are familiar with the terminology and find them fairly straightforward. And those of them that are new to derivatives, where they're being hit with all of this baffling terminology, and it tends to be confusing. I always think derivatives is like learning a foreign language. Once you can speak it, it's easy. But actually, until you can, it can be a bit baffling. Okay, so let's talk, therefore, about hedging, hedging existing risks. I'm just going to bring up my whiteboard. Okay, here we go. So let's talk about a farmer. Now, a farmer obviously has wheat growing in the ground. And if you're a farmer growing wheat, your big risk, of course, would be by the time your crop matures and is ready to go to market, wheat prices might have collapsed. So we would talk about our farmer as being long wheat. Now, this means they are long the underlying asset. So they own wheat. And if you're long an underlying asset, typically you're worried about prices essentially falling. So what you would do to hedge this position is go short a wheat forward. And you would tailor that wheat forward to have the same delivery as the maturity of your wheat growing in the ground. Now, the basic idea is the short wheat forward would lock you into a guaranteed selling price for your wheat. And that, of course, now means you're not exposed to the vagaries, the uncertainty of wheat prices fluctuating in the marketplace. Now, actually, you may as well do this you can hedge with using futures as well. And what we tend to find is any gain or loss on the underlying wheat will be offset by a gain or loss on the forward. So in other words, if wheat prices go up, you'd gain on your long wheat position, but you'd lose on the wheat forward. Okay. Whereas if prices come down, you'd lose on the long wheat position, but you'd gain on the short wheat forward. Okay, so in other words, the gains and losses are meant to offset. The gains and losses on the underlying asset and essentially on the forward contract should offset. So you're locked into a guaranteed selling price. You no longer have any uncertainty. Now, let's talk about a party that is short the underlying asset. Let's talk about, I'm going to talk about a chocolate manufacturer, let's say Cadbury's, essentially, who manufacture chocolate. Now, they are going to be short, essentially, cocoa, okay, which is the underlying asset. Why are they short cocoa? Well, of course, they simply aren't going to have all the cocoa that they need for 1 year's worth or more of chocolate production. So when we talk about short an underlying asset, and this confuses candidates, but when we talk about being short an underlying asset, it means you don't have the underlying asset, but you're going to need to purchase it in the future. So short underlying, don't have underlying asset, but I need to purchase in the future. Now, if you therefore you are short an underlying asset, your big risk is that that underlying asset rises in price over time. So when you come to purchase it, it's going to cost you more money. So you're going to need a forward position that wins when cocoa prices rise. So what we're going to do essentially is go long a cocoa forward. Okay. And that way, if prices do rise, I lose on my short underlying position, but I win on the long forward contract, and those profits and losses should offset. Okay, so for hedging, it's fairly straightforward with forwards and futures. You just do the opposite of your underlying position. So if you own the underlying asset, you're long, in which case you will need to go short a forward or a future. If you are short the underlying asset, meaning you don't have it but need to purchase in the future, then essentially you go long a forward contract. Okay, they never really mention that, as I say, in the CFA syllabus, but it's rather assumed knowledge. So I thought it was worth covering that there. Okay, so that's what we mean by hedges. It's trying to hedge the risk of an underlying asset. Now, what about settlement at expiration? This is the delivery date in the forward contract. As we said, when you enter a forward contract, today, all you're doing is locking into the forward price. Delivery doesn't take place until the expiration of the forward contract at some point in the future. Okay, so what happens on expiration? Delivery of the asset. This will be essentially the short party. So the short party, because they've agreed to sell the underlying asset, they're going to deliver the underlying asset and they will receive the forward price. The long party, of course, is taking receipt of the underlying asset. So they're gaining the underlying asset and they are paying the forward price. So many forward contracts are physically delivered. In other words, short party delivers the underlying asset, long party pays the forward price. But not every forward contract. Some are cash settled. Now, cash settled forwards tend to be when it is very difficult to deliver the underlying asset. So let's say I've got the underlying asset is the FTSE 100. So 100 of stocks on the London Stock Exchange weighted according to their market capitalization. Well, that would be very difficult for the short party to deliver. How do you deliver, a market cap weighted index? It might contain fractions of shares. Going to be too difficult. So in that situation, the contract is likely to be cash settled. So all we do is we look at the difference between the forward price and the underlying asset price at the delivery date. Okay, we compare the two together, and then loser pays winner the value. So the party with negative value pays. So all we're going to do is compare the stock price. Essentially, we're going to compare the stock price to the forward price. And if the stock price is greater than the forward price, essentially, then there has been a gain for the long party, because they are essentially paying the forward price but receiving stock that's worth more. So in this situation, if the stock price is greater than the forward price, or underlying asset price is greater than the forward price, then in that situation, short party pays long party. If we've got a situation where the underlying asset price is less than the forward price, well, this time the long party will pay the short party. So whoever has negative value will pay if it is a cash settled forward contract. Forward rate agreements, Frars as they are known, these are interest rate based products. So they tend to be based on LIBOR, the London Interbank Offer Rate. Let's explain roughly how a FRA works, because it's a throwaway area at level 1. They mention FRAs, but when we get to level 2, we're going to be expected to price a FRA and value a FRA, both during the FRA's life and at contract delivery. So it makes sense to kind of get an understanding of this now. So again, I'm going to go back to my board, and I'm going to make up an example of a FRA. It's always dangerous to make up examples, but I'll give it a go. Let's see if I can get another new page up. Hang on a second. There we go. So let's imagine we've got a 3 times 5 FRA. 3 times 5. Let's first of all, we need to be able to interpret these. So this is the expiry of the FRA, forward rate agreement, in months. So this FRA will expire in 3 months. And because we're using LIBOR, we're going to assume there are 30 days in each month. Now, in practice, different currencies, LIBOR interest rates are either 365 days in a year or 360 days in a year. CFA Institute does not expect you to know, oh, dollar is 360, sterling is 365, etc. So we can assume that all LIBOR rates given to us at any level of the CFA exams are 360-day rates. So this FRA will expire in 3 months' time, 3 times 30, so actually it's expiring in 90 days' time. So that's when our FRA is going to expire. Second number that you see there is the end of borrowing and lending. Okay, so that's month 5. 5 times 30 is going to be, of course, 150. So what is this FRA allowing us to do? Well, what it's going to do is if you are long the FRA, you will pay fixed, receive floating interest from day 90 to day 150. So long FRA is going to be pay fixed, receive floating interest, and floating is based on LIBOR, from day 90 up to day 150. Now, if you're looking at a short FRA, it's just going to be the opposite way around. So a short FRA is going to be pay floating and receive fixed. Okay, again, from day 90 to day 150. So let's have a look at how these things actually work. So let's just draw a timeline. So here we are at T0, where we're thinking about entering the contract. We've then got T90, which is the expiry of the contract. And we've got T150, which is the end of the borrowing and lending period. Now, what happens with the FRA is when you enter the contract, we find out the forward price. The forward price in a FRA is always the fixed interest rate. So we're going to find out our forward price, and that is equal to the fixed interest rate. Now, at level 1, you're not expected to know how this fixed interest rate is actually calculated. However, if you've already covered your fixed income, you actually have the tools available for you to work that out. Because if you've got a 90-day interest rate and a 150-day interest rate, you could work out a forward interest rate from day 90 to day 150. So in fact, the fixed interest rate in a FRA is just a forward interest rate. And we'll be using that knowledge at level 2. So we enter the fixed interest rate. We then get to the expiry of the FRA at T90, so at day 90. This is when we discover the floating rate. In this case, our floating rate would be 60-day LIBOR. Okay. Now, we now have at day 90 both the fixed rate and the floating rate. Remember, at T0, we know the fixed rate, but we do not know the floating rate. Now, that means we then have our 60-day borrowing and lending period. I'm just going to change the color of my pen for a second. So we now have our 60-day period. Back to my blue color. So at the end of T150, so at the end of the borrowing and lending, we can work out the profit or loss to the long party. Remember, they've agreed to pay fixed, receive floating. So their profit will be the floating rate. I'll just put it as LIBOR 60. So they're going to be receiving LIBOR. They're going to be paying the forward price, which is the fixed rate. Now, typically, both LIBOR and the fixed rate will be quoted as annualized interest rates. So we would actually then need to unannualize because we're only looking at a 60-day period. So we do that by multiplying by 60 over 360, and we multiply by our notional principal. And that gives us the profit or loss on the FRA at the end of borrowing and lending, i.e. T150. In practice then, and again, don't worry too much about this now, but in practice what then happens is any gain or loss is then discounted back from back from the end of borrowing and lending to the expiry date. So we take our gain or loss and we do it over 1 plus 60-day LIBOR to work out what the value is at the expiry of the FRA, and it's actually paid, therefore, from loser to winner at day 90. Now, notice from the long party's point of view, and I've done this calculation here from the long party's point of view, they're receiving the floating rate and paying the fixed rate. So therefore, the long position in a FRA is going to benefit when floating rates rise over time, so when interest rates are rising. So a long FRA can be used to speculate on interest rates. If you think interest rates are going to rise, go for a long FRA because this rate will go up, meaning you get a bigger payoff at the end of the borrowing and lending and therefore a bigger payoff on the contract. So long FRA can be used to speculate on interest rates rising. Now notice with our short FRA, it's just going to be the opposite way round. Okay, so in other words, the value at expiry for the short FRA would be the fixed rate minus LIBOR 60, then unannualized and times the notional principal. So of course, they're going to benefit when the floating rates decrease in the marketplace. So if you want to speculate on interest rates falling, then of course you could use the short FRA position. So FRAs can be used, therefore, to speculate on interest rates, but that's not all they can be used for. They can also be used by companies to lock into fixed interest rates for future borrowing when they only got access to floating rates in the marketplace. Let's just explain that for a second. So let's imagine we've got a company, and this company is going to need to borrow, but not today. It's going to need to borrow in the future. Let's say it's going to need to borrow for 180 days in, I don't know, let's say 3 months. So our company is going to need to borrow for 180 days in 3 months' time, and it's only got access to bank finance. Now, when you look at bank loans, most of them are floating. So the big risk for our company here is by the time they come to borrow in 3 months' time, 180-day LIBOR will have risen and it will cost them more to borrow. And they want to eliminate that risk. So what our company is going to go out and do is it's going to take a long FRA. And they would need, let's see, what would they need? They would need a 3 times 8, a 3 times 8 FRA. Okay, in other words, the borrowing and lending expires in, sorry, the FRA expires at month 3, which is day 90. Okay, and then you enter borrowing and lending from day 90 up to day 270. So again, end of borrowing and lending would be 270 days in this contract. And of course, between 90 and 270, we have our 180 days. Now they take out the long FRA, and of course they lock themselves into a guaranteed forward price, the fixed rate. So let's imagine our fixed rate in the FRA is quoted at, let's say 4%. Now let's imagine then that time now passes. So 3 months now pass. So let's say our 3 months have passed. I'm just going to sort of change that thickness of this pen. It's a little bit, come on, there we go. Still a bit thick. Okay. So 3 months have now passed. So the company now wants to take out its borrowing. And let's say interest rates have risen to 6%. So 3 months have passed, interest rates have risen to 6%. When it takes out its loan, the company is now going to be paying 6% on its finance. But remember, it's got the long FRA, which is pay fixed, receive floating. Okay, so in other words, they would be receiving 6 minus the floating rate, which, 6%, which is the floating rate, minus the fixed rate of 4%, a net 2% would be coming in on their FRA. So they're paying 6% on their loan, receiving 2% on the FRA, and lo and behold, the company's net interest burden on its loan is 4%, which of course is the same as the fixed rate that they locked into. So, of course, therefore, these FRAs can be used to lock into fixed rates for future borrowing for companies. Now, again, this is one of the big reasons FRAs are used. And again, the CFA Institute doesn't really mention why they're used. And I find it very difficult to understand something unless I've got a bit of context. Well, that's all very good if LIBOR rates rise. And in this case, they rose to 6%. But what happens if they've fallen over time? So let's do another example. Let's imagine we've got a rate. Let's do a green pen this time. Let's imagine rates have fallen to 2%. Okay, so this time 3 months pass, and then you find out 180-day LIBOR is 2%. Well, from the company's point of view, they're paying 2% on their borrowings, which is nice. But think about the long FRA now. They are receiving 2%, 180-day LIBOR, and they're paying the fixed rate of 4%. So this gives them a -2 on the FRA. In other words, they're losing on the FRA. They're having to pay out to their counterparty. Okay, so they're paying 2% on their loan. They're paying 2% on the FRA. And lo and behold, overall, the cost of their borrowing is 4%. So you can see what's happening from the company's point of view here. By using a FRA, essentially what they've done is locked into a fixed rate for future borrowing, even when they've only got access to floating bank loans. From the company's point of view, the beauty is they know exactly what they will be paying on their loan that doesn't even commence until 3 months' time. Good news is, if interest rates have risen, they will have locked into a lower rate than they could have borrowed at. However, if interest rates have fallen over that 3-month period to the expiry of the FRA, unfortunately, they've locked into a higher rate. But what they do have is absolute certainty. Okay, so that is essentially what is going on with the FRA. As I said, we're going to come back to this at level 2, and we're going to look at it in more detail. And in particular, we're going to do the maths behind it. How do we arrive at the forward price, the fixed rate? Well, it's a forward rate, just like you calculate forward rates in fixed income using spot rates. It's actually easier than fixed income because we're going to use LIBOR rates rather than spot rates, and therefore there's no compounding. But that's an issue for level 2. Notice what we've got down here. So long is paying fixed, receiving floating. We covered that. Short party just the other way around. Long party therefore gains when the floating rate increases because they're paying fixed and receiving a higher floating rate. Okay, so long can speculate on interest rates rising. Long wins when interest rates rise. Short party is doing the opposite, paying floating and receiving fixed, so they gain when the floating rate decreases. Fabulous. Okay, so there is our forward contracts. Let's turn our attention now to futures contracts. Now, with a future contract, it is essentially the same as a forward contract. The only difference is it is exchange traded. Okay, so there is an exchange, a platform for trading them, and therefore there's also a clearinghouse. And the clearinghouse is going to absorb credit risk. So with forwards, we have credit risk if one party defaults. With futures, we do not have credit risk because if one party essentially defaults, the clearinghouse steps in and guarantees performance. Now, notice it says standardized forward contract. So a lot of the features of futures are standardized, unlike forward contracts where they're bespoke. So with a forward contract, you can tailor everything, but with a future, it is going to be standard. So the asset is standardized in terms of its quality. Now, that's going to be important if you're looking at things like commodities. You know, if you're looking at coffee, you would want to know exactly what coffee beans you're receiving, exactly how many bits of grit and rotten beans can be in a bag, etc. If you were looking at a gold future, you would be very interested in the carat of gold that's going to be delivered. So they're going to standardize the quality of the asset. The contract size is going to be standardized as well. So this is the amount of the quantity of one futures contract that is going to be standardized. So the amount of the underlying asset. And notice they also say quotation. And when we look at quotation, we're talking about tick size. Tick size is just the minimum fluctuation in the forward contract price. Any movement in the underlying asset below the tick size is not reported. Tick value is simply the change in the value of one futures contract for a 1 tick movement in price. Notice they would also standardize delivery dates, so when the contract comes to delivery, and the method of delivery. So method of delivery can include where you have to deliver the underlying asset to, and of course, if you're a short party, that's very significant for you. Where you have to deliver the underlying asset, when you have to deliver the underlying asset, do you have to load it onto a boat, etc. So delivery dates and methods are all standardized. Why do we have this standardization in futures markets? Well, it's to ensure that we have a lot of identical contracts trading on the exchange. Why do we want lots of identical contracts trading on the exchange? One word, and that word is liquidity. Okay, so the fact that we have all of these identical contracts trading on the exchange means we have a lot of liquidity. And that's going to make it easy to close out your position before delivery. Okay, so if I go long a future, all I need to do to close out my position is go short an identical future with the same delivery date. Now, of course, the big difference between long and short will be the difference in the futures price between entering and closing out that position. So most futures are actually closed out prior to maturity. They don't go through to delivery. It's very, very rare that they will go through to delivery. And it's that liquidity if the futures markets that make them ideal for speculating. Okay, you want to speculate on a wheat harvest? Well, do it with a wheat future. You know, I'm guessing you don't actually want a lorry to turn up to your house and say, hey, where do you want the wheat? So you don't want it to go to delivery. Last thing you want is all the wheat. You just want to speculate on the underlying asset moving. So you use the wheat future and close it out before it comes to maturity. Okay, let's talk a little bit therefore about the clearinghouse and how those work in the futures markets. And of course, clearing actually is being extended to the forward markets as well. It's just that our syllabus hasn't particularly caught up with that point yet. Right, okay, so let's talk about it. So let's say we've got two counterparties, counterparty A and counterparty B. And let's say A is going to go long and B is going to go short. And it's a wheat future, let's say. So it's a wheat future and the futures price is, let's say, $80 a ton, and it's going to be delivered in 3 months' time. So the long party is agreeing to receive wheat and pay $80 a ton in 3 months' time, and the short party is agreeing to deliver wheat and receive $80 per ton in 3 months' time. So that contract is entered into on the exchange. Now what happens is the clearinghouse gets involved. So the original contract is now ripped up, and this is a process known as novation. And instead, our clearinghouse is going to step in. And it's going to say to counterparty A, hey, I will be your counterparty. So I will be your short position at $80 per ton. And for counterparty B, who went short, the clearinghouse goes long at $80 per ton. So notice from the clearinghouse perspective, everything offsets. They're agreeing to buy wheat at $80 per ton in 3 months' time, and they're agreeing to sell wheat at $80 per ton in 3 months' time. So, providing counterparty A or B does not default, the clearinghouse has no risk at all. But, of course, the risk for the clearinghouse is one of those counterparties' defaults. So let's say B defaults. Well, of course, this then is all wiped out. And now the clearinghouse is having to go short with counterparty A. In other words, the clearinghouse would have to deliver wheat in 3 months' time and receive $80 per ton. So clearinghouse is stepping in there and they're absorbing the credit risk in the futures market. Now, I guess you could say there's still credit risk. What happens if the clearinghouse defaults? But in practice, no clearinghouse has ever defaulted in the history of futures markets. But you might be thinking, what's the motivation of the clearinghouse to do this? It's absorbing credit risk. Why would it do this? Well, what the clearinghouse does do is it requires a good faith deposit from both counterparties A and B to cover it for credit risk. Okay, and that deposit the clearinghouse receives is known as initial margin. And it's paid by both the long and short parties. So both A and B would pay the clearinghouse. Now, initial margin covers, or it's designed to cover 1 day, I should say, rather than days of losses. Why 1 day's worth of losses? Well, we're going to see in a second that futures are marked to market on a daily basis, essentially. So what that means is if a counterparty ever defaults in the futures market, they've only defaulted on 1 day's profit or loss. You don't need to know how initial margin is calculated, but they use, in the derivatives markets, mainly around the world, they use a program called SPAN, which was developed by, I think it's Chicago Board of Trade. And what it does is it runs multiple volatility simulations on the underlying asset. And then initial margin is calculated as the biggest daily loss that those volatility scenarios drove. Okay, so counterparty A and counterparty B pay the clearinghouse a deposit, but notice it is a deposit, okay? It's not a price that they're paying. They will get that deposit back, and they actually get the deposit back plus interest, and they get it back in 2 scenarios. Either they close out their positions, okay, prior to maturity, Now, once they've closed out their positions, their delivery obligations offset and there's no more risk for the clearinghouse, so they will return the deposit, or the contract goes through to delivery and then they get the return of their deposit. And as I said, they get deposit plus interest. What do I mean by all of this closing out? Let's just talk briefly about closing out in the futures market. So let's go back to A and B. They've got their wheat future. Oop, I could spell wheat, be dangerous. So they got their wheat future at $80 a ton. And let's imagine some time passes. And of course, the wheat futures price will be fluctuating in the marketplace. And let's say A had been long this transaction and B had been short. And A now decides to close out their position. So what they're going to do, let's say 1 month has passed. So initially it had 3 months on the contract, okay, to delivery. So 1 month now passes and A decides to close out their position. So what they're going to do is enter another futures contract. But the key is they're now going to take the short position, because if they are long and short, their delivery obligations will offset. Now, because 1 month is passed, they now need a 2 month wheat future. Let's say their counterparty is called C. And let's say the 2 month wheat future is now trading at $90 per ton. Well, counterparty A is now out of the game. Their long and their short positions offset, their delivery obligations offset, okay? And remember, both contracts are expiring at the same time, okay? And therefore, they get the selling price. They shorted, so they've agreed to sell wheat at $90 per ton. They've agreed to buy wheat at $80 per ton. So they've made a $10 profit, and they will receive that profit at this point in time, and their delivery obligations offset. Now, of course, counterparty C, they must have gone long in this position. So at the moment, we've now got counterparty A having closed out their position, but both C and B are essentially still open positions. So let's imagine another month passes, so there's now 1 month delivery, and counterparty B and C decide to close out their positions. Let's get a color up here. So they're going to close out, and they're going to do it by equal and opposite. So counterparty B is now going to go long, and counterparty C is going to go short. Okay, we've got 1 month to delivery, so they'll need a 1 month futures contract, wheat future. And let's say at this point in time, the price is on that futures contract is $95 per ton. Now notice, at this point in time, all of the counterparties have closed out. Okay, let's have a look at counterparty B. They shorted, in other words, agreed to sell at $80 per ton. They're agreeing to buy back here by using the 1 month future contract at $95 per ton. So in fact, they've made a loss of $15 per ton. And then finally, if we look at C, they sold at $95 per ton. They buy at $90 per ton. And therefore, they've made a profit of $5. Now, what you might notice is the total profits, $15, are equal to the total losses. So we talk about the derivatives markets and futures markets as being a nil-sum game. One person's profit is another person's loss, okay? And the profits and losses in total cancel out to zero, okay? Now, somebody actually I had in a class years ago got irate about this. They said, what happens to the wheat? Nothing. Everybody's closed out their position. No wheat is changing hands in this position. All they've done essentially is speculated on the underlying positions. Okay, they've speculated. And remember, the counterparties A and C initially went long, so they were speculating that prices would rise. And counterparty B initially went short, so they were speculating that prices would fall. And you can see A and C have made profits because futures prices have risen, and B has made a loss because futures prices have fallen over that period. Now, therefore, in this market, there are no open positions. Right, let's get back to our slides. Good. So what were we talking about? We were talking about the clearinghouse. So they're acting as counterparty, long and short, to both long and short, guaranteeing performance, but requires this margin. And as we said, this margin is a deposit. Initial margin, as it's known as, is a deposit. It's paid by both long and short, okay? Different calculation than equity margin. This is mentioned because in one of the equity readings, it talks about margin, and that is margin when you borrow money to buy a security from your broker. Okay, this has nothing to do with borrowing money from a broker. This is essentially derivative contracts. So even though they talk about an initial margin and maintenance margin in both areas, just be careful. The way it works is not the same. And we're talking about derivatives here rather than borrowing from your broker. Okay, so this here, borrowing from your broker, and it's explained in the equity readings at level 1. So notice there you are, there's your initial margin. It is a performance guarantee. It protects the clearinghouse from 1 day's profit, or 1 day's loss on the contract. They give it back in 2 scenarios, as we said, either when a counterparty closes out their position, because then their buying and selling positions offset. In other words, their delivery obligations offset, and there's no longer any risk for the clearinghouse. Other scenario is the contract goes through to delivery, but that is rare in futures markets, as we said. Now, here's the second point we mentioned. Why does that initial margin only need to protect the clearinghouse for 1 day's profit or loss? Well, it's because of the mark-to-market features in this. In other words, what the clearinghouse does is it says at the end of each day, what is the profit or loss for each counterparty? Okay, and it takes the profit, or it takes the loss from the loser, and it pays it to the winner. In fact, it essentially subtracts the loser's daily loss from its initial margin and pays it into the winner's margin account. Okay, so in other words, futures contracts, unlike forward contracts, are marked to market daily. Okay, and as you can see, they're going to add gains to your initial margin, and they're going to subtract losses from your initial margin account. Okay, now if you're long a forward or a future, you're going to make gains when the underlying asset rises. So as long as the underlying asset is going up in price day to day, okay, you're making profits, and those are daily profits are being added to your margin account. However, if you are long a futures contract and the underlying asset starts to fall, then you're going to start to make losses, and those losses are going to be subtracted from your margin account. Now, there's a problem, therefore. If we're making losses in our futures position and those losses are being deducted from our margin account, the balance in our margin account is getting smaller and smaller and smaller. And remember, your margin account is used by the clearinghouse to protect it against default risk. It's meant to cover the clearinghouse if you were to default on your position. So the problem from the clearinghouse's point of view is as a counterparty starts to make losses, the margin is getting smaller and smaller in their account, and therefore the protection the clearinghouse has from default is getting smaller and smaller and smaller. As a result, most clearinghouses set a maintenance level of margin. Now, this is the minimum level of margin that you can have in your account. If losses take your margin below this level, then you need to top your margin back up all the way up to its original initial margin level. Okay, so notice if you breach the maintenance level, you'll get what's called a variation margin call from the clearinghouse. They'll phone you up and say, right, you breached the maintenance level, top your margin all the way back up to its original level. And it's important to realize here that you do have to top all the ways to your original level. Again, when we look at equity margin on borrowing from brokers, it's not topping it all the way to the original level. It's just topping it up to a maintenance level. Okay, so you have to top your margin all the way back up if you breach that margin account or close out your position. Okay, so how do they work out these daily profit or losses? Well, what they're going to do is they're going to compare your price yesterday. Okay, so let's say here's the futures price yesterday on the exchange. and they're going to compare it to the daily settlement price. And that's just the average of prices it traded in the marketplace in the last period of trading during the day. So they're going to then compare that to today's daily settlement price. Now, essentially, if today's daily settlement price is above the futures price, so let's say you are long, then this is good news, because they say, let's imagine you closed out at the daily settlement price. Here's yesterday's price, okay, and the difference is your profit. Whereas from the short party's point of view, it's just the other way around. So they're comparing the futures price, yesterday's futures price, to the daily settlement price today. Again, 1 day's profit or loss. 1 day's gain for the long is equal to 1 day's loss for the short. So they simply compare the future price yesterday to today's futures price, and that's how they calculate the daily gain or loss. And remember, they're then transferring that into your margin account. So if you made a gain, your margin account's going up, and if you made a loss, your margin account is going down. Notice daily price limits, not very excited about this. Limit up and limit down. These are just designed to dampen volatility in derivatives markets. One of the big criticisms of derivatives is they are, often people claim they make markets more volatile. Well, in a period of massive volatility, the exchange might introduce limits up or limits down. These are just futures prices outside of which you cannot enter a contract. So essentially, in a rapidly bearish market, they might introduce a limit down, and that would stop you entering a futures contract at a price lower than that lower limit. So essentially, what it does is it gives the market time to pause and consider. Most exchanges do not have daily price limits, except for in periods of high levels of volatility, and they're just designed to slow down the price changes. Open interest is the number of contracts that are outstanding, i.e. have not been closed out. Why would I care about open interest as a participant? Well, of course, it gives me a good idea of liquidity. Okay, the more open contracts, the more people are trading in the marketplace or will need to trade in the future. Again, remember what we said in our example on the previous on my previous sketch. Look, the open interest here is 0. Everybody's closed out. All their deliveries obligations offset. Okay, so in this situation, there would be no open interest. There is no liquidity left in this marketplace. So if you're thinking about trading in futures, then open interest gives you a nice indication of how liquid that marketplace is. Anything else to say on this slide? Oh, just one box we didn't talk about where it says futures contracts. Yes, they're exchange traded. Yes, they're more liquid due to the standardized process and the fact that they're exchange traded. Yes, there's no default risk. The clearinghouse absorbs that, but they require that initial margin deposit. And yes, they are marked to market on a daily basis, meaning essentially, if anyone ever defaults, they've only defaulted on 1 day's worth of profit or loss, rather than the profit or loss all the way from initiation. And that's a big difference with forwards. Someone defaults on a forward and they defaulted on the contract, on the profit or loss, all the way from when the contract was entered until the point of default. Right, okay. Sorry, let's get my cursor back. Let's have a go at doing a couple of questions. These are CFA Institute questions. So let's have a look. Exchange traded derivatives are largely unregulated. No, they're exchange traded. Whole point of exchanges are they are a protective environment in which to trade. So they are going to be regulated, of course. Traded through an informal network? No, that would be over the counter. Okay. Remember, essentially here they're traded on normally an electronic platform. Guaranteed by a clearinghouse against default? Yes, exchange traded derivatives are guaranteed. And as we mentioned, due to the credit crunch in 2008, a lot of banks that held forward derivative positions, over the counter derivative positions, actually made losses due to default. One big defaulter, of course, was Lehman Brothers when it went bankrupt, and it was actively involved in over the counter markets. So a lot of its counterparties actually made losses when Lehman's defaulted on derivatives contracts. As a result of this, there's a move towards pushing forward contracts onto a clearing system so that they have initial margin, guaranteed performance, and daily collection of profits and losses. Okay, just be aware of that in the back of your mind. Okay, but we're saying no, forward contracts are no clearinghouse, futures contracts do have a clearinghouse. Right, okay, so this question is on forward commitments. Forward commitments subject to default are forwards and futures. They're certainly forwards because there's no clearinghouse, but they're not futures because there is a clearinghouse, which of course absorbs that credit risk. Futures, no, they're protected. And interest rate swaps, well, swaps are over the counter. Okay, so they would essentially have credit risk in interest rate swaps. Interest rate swaps and forwards, yes, interest rate swaps are over the counter, forwards are over the counter, so they both have no clearinghouse, they both have credit risk, so our answer should be C. And lo and behold, there it is. Which of the following derivatives is least likely to have a value of 0 at initiation of the contract? Well, the basic rule is we have two types of contracts. We have forward contracts, which really cover forwards, futures, and swaps, okay, where you are contracted to do something. And we have options, and options are referred to as contingent claims. And typically, if you buy an option, you're only going to exercise that claim if it is profitable to do so. Now, actually, what that means is when they are priced, futures, forwards, swaps, they're always priced so that there is no gain or loss to counterparties at initiation of the contract. However, with an option, the short party is always taking on risk and they need to be rewarded for that risk. So there will always be a price for an option. Okay, so least likely to have a value of 0, it should be B, are options. And we'll talk more about options in just a little while. So derivative that is least likely a contingent claim. Well, a contingent claim is where the buyer of the underlying derivative has a right, but not an obligation. Now, a put option gives you the right to sell an underlying asset, but not an obligation. Okay, so put options are definitely going to be a contingent, we're looking for least likely a contingent claim. So a put option is a contingent claim. Credit default swaps are contingent claims. Credit default swaps are taken out. They're insurance contracts, essentially, on bonds. So let's imagine you're a bond fund manager. Your risk is some of the bonds in your portfolio default. So you might take out credit default swaps. And these will pay out if there is a default in your bond portfolio. Now, it's a contingent claim, of course, because they only pay out on default. If the bond doesn't default, there's no payment. So essentially, A and C are contingent claims. Equity swap is a forward commitment. Okay. So credit default swaps, just watch out. They are contingent claims, even though they have this name swap. In fact, I don't really want you even to think of them as swaps. I mean, legally they are, but essentially they are insurance contracts. You're insuring a bond against default, and therefore if that bond defaults, you get a payment. Okay. So think about CDSs, credit default swaps, as being insurance contracts, and you won't go too far wrong. Right, that takes us into a little bit about swaps now. Now, swaps, what you're doing is agreeing to exchange a set of cash flows over time. And of course, probably the most famous one that we have in terms of swaps is a plain vanilla interest rate swap, where one party is agreeing to pay fixed payments over time, and the other party is agreeing to pay floating payments over time. Now, the present value of the fixed and floating payments will equal each other at initiation, so neither party gain or lose. Typically, we talk about the party paying fixed as being long in the swap, and the party paying floating as being short in the swap. So in an interest rate swap, the long party is paying fixed and receiving floating. The short party is paying floating and receiving fixed. Does that sound familiar? Sounds a little bit like the FRA. A long FRA was pay fixed, receive floating, and a short FRA was pay floating, receive fixed. So what's the difference between a FRA and a swap then? Well, a FRA is pay fixed, receive floating if we're looking at the long party, and it's a one-off transaction. Whereas a swap, you're going to be, as a long party in the swap, paying fixed, receiving floating at fixed points over the swap's life. Okay, so in other words, there's going to be multiple sets of cash flows exchanged rather than just one. Now, again, because swaps are over the counter, we can customize the amount, the notional principal, and also the time horizon. How long will the swap last? How frequent will interest payments be made? Now, the idea is there's typically no payment by either at initiation. We ensure that the present value of the fixed payments equals the present value of the floating payments at initiation, so there is no gain or loss to either counterparty at initiation. Good. It's an over-the-counter market, so it's largely unregulated, and of course there is counterparty risk. Okay, now we've said here, plain vanilla interest rate, pay fixed, receive floating. Well, yes, that's true, but that's true for the long party. No gain or loss at initiation because the present value of the fixed payments equal the present value of the floating payments. After initiation, then essentially, so the value of the swap after initiation, so this is at initiation. So the value after initiation, well, now the present value of the fixed payments no longer equal the present value of floating payments. And the gain or loss is the difference between the two amounts. If you're paying fixed, receiving floating, then your gain at any point in time will be the present value of what you're paying compared to the present value of what you're receiving. So if you're long, I'm paying the fixed amounts, I'm receiving the floating amounts. So if I do present value of floating minus present value of fixed, that will give me the value at any point in time. But remember, the value at initiation is always 0. Now, again, at level 2, we're going to take this and we're going to talk about essentially how do we actually price the swap. Just like a FRA, the FRA, remember, the price of the FRA was the fixed rate. Okay. In a swap, again, the price of the swap that's set at initiation is always going to be the fixed rate. So at level 2, we'll look at how we price them and how we value them. And we use a lot of analogy with bonds when we do this. Can you think of another way of creating a scenario where you're paying fixed and receiving floating payments? Well, how about doing it with bonds? How about issuing a fixed coupon bond? I'm now paying fixed, taking the proceeds and buying a floating rate note, so I'm receiving floating. So you can replicate an interest rate swap by using bonds. And that's going to be critical to understanding how we price and value these in the level 2 syllabus. But at level 1, all you need to really know is the basics here. Yes, very similar to a series of FRAs with fixed rate equaling the swap fixed rate. Yeah, one question I got asked a while ago was, could I create a swap using FRAs? The answer is yes, but you need to use off-market FRAs. What the hell do I mean by that? Well, the problem with a FRA is its fixed rate is a forward interest rate. So each FRA, according to its maturity date, because each maturity date would be different, you'd have a different fixed rate. Whereas a swap has the same fixed rate throughout its life. So what you would need to do is create a series of FRAs where each FRA has the same fixed rate regardless of its expiry date. Now, the problem with that, essentially, is those FRAs would no longer be priced, so there's no gain or loss at initiation. And a forward contract where there is a profit or loss to one of the counterparties at initiation is known as an off-market forward contract. Right, let's turn our attention a little bit to credit derivatives. So credit derivatives are typically going to provide protection for bondholders or lenders. And we've already talked briefly about the credit default swap. And remember, and I like the fact that they've used insurance here, it is insurance. Okay. What you're doing when you buy a credit default swap, so when you buy a credit default swap, you are shorting credit risk. You're going short credit risk. Oh. So it's actually quite confusing when we look at CDS's, credit default swaps. Sorry, my pen's not working there. Come on, there we go. Because when they talk about long and short from credit default swaps points of view, they talk about it from credit risk perspective. So if you buy a credit default swap, you're actually short credit risk. So essentially the short party is the person that purchased it. I know, very confusing, because in all other contracts, when we talk about a long position, we're saying, hey, you've bought the underlying contract. But here, essentially, actually, you buy the underlying contract and you short credit risk. So we talk about the CDS as being a short position. So of course, if you buy a bond, when I buy a bond, I am long interest rate risk and any other risk the bond has. In particular, of course, if we're not looking at government bonds, we're also long credit risk. Of course, some government bonds outside blue chip economies are also exposed to credit risk. So when you buy a bond, you are long interest rate risk and credit risk. But the idea is CDSs allow us to separately trade interest rate risk and credit risk. Because if I want to get rid of that contract, I'm a bond holder and I want to get rid of credit risk, then what I do is I buy the CDS, okay, which of course shorts the credit risk. So notice, therefore, the long credit risk on the bond and the short credit risk on the CDS offset, and therefore I'm now only exposed to the interest rate risk on the bond. So therefore, CDSs can be used by bond holders to insure against credit risk, but they can also be used to speculate on credit risk, because eventually the value of a CDS will increase as the credit risk of the underlying bond deteriorates. So if you think a company's credit risk is going to get worse, then essentially what you'd want to do is go long the CDS and short their credit risk, because it will become, that short position will become more valuable as their credit risk deteriorates. Likewise, if you think that their credit risk is going to improve, then essentially what you do is go short the CDS to expose yourself to their credit risk. Shorting the CDS gives you a long credit risk exposure. Okay. Credit risk spread options, these are options, as you can see, and these are based on credit spreads. Now, credit spread, of course, is just the yield on a bond, the very simple one that we look at, where we look at yield to maturity, maybe on our corporate bond, and compare it to yield to maturity on a equivalent government bond. That, of course, is our G spread. We also look at Z spreads where we do this with spot rates, etc. So all the credit spread option is going to do is it's going to give you protection if this spread widens. Okay, if this spread widens, it's because typically the yield to maturity in your corporate bond is rising. Why would yield rise if there is more credit risk? Remember, yield is the return that a bondholder makes. They will require a higher return if there is more chance of default. And of course, as yield goes up, bond price comes down. So as the yield on your corporate bond goes up, then the credit spread option pays out to protect you against this. Good. Okay, there's a bit of swaps and credit derivatives. Oh, back on to some questions. So prices of swaps, typically zero at initiation. That is true. Remember, with our plain vanilla interest rate swap, the present value of the fixed payments are equal to the present value of floating payments at initiation, so there is no gain or loss to either of the counterparty. Then, of course, as we pass through time, interest rates change in the marketplace, so the present value of the fixed is no longer equal to the present value of the floating, and therefore one of the counterparties makes a gain and the other makes a loss. Price of a swap fluctuates over the life of the contract. No. Okay. The price of the swap, okay, is the fixed rate. Oh, hang on a second. Did I just misread question 1? The price of the swap is typically 0 at initiation. No, no, no. The value is 0. Okay. The price is equal to the fixed rate. And of course, that fixed rate is set, so there is no value. So the present value of the fixed payments equal the present value of the floating payments. Sorry, be very careful. It said price, not value. Okay, so price is not 0 at initiation. Price does not fluctuate. It's the fixed rate. It is constant. Value fluctuates, of course. Okay, but price doesn't. Is obtained through a process of replication? Yes. Essentially what we do, our replication process says, okay, we can create this by going essentially issue a fixed coupon bond. Okay, issue a fixed coupon bond. We are now paying fixed, and take the proceeds and buy a floating rate note. Okay, now what do we know about floating rate notes at initiation? Floating rate notes trade at par. Okay, so they're going to trade at par at initiation. So what we actually do with the price of our fixed interest rate swap is we mess around with the coupon rate on the bond so that it also trades at par at initiation, so that the present value of the fixed coupon bond is equal to the present value of the floating rate note. Don't worry too much about that in detail, because we're going to look at the calculations behind it in the level 2 syllabus. But just be aware that, you know, sow that seed that it's all about, it's really all about bonds. But in the background, we can replicate a long interest rate swap, pay fixed, receive floating, by issuing a fixed coupon bond and buying a floating rate note. We know the value needs to be 0 at initiation, so there's no gain or loss to either counterparty. We know the floating rate note trades at par, so we need to work out the coupon rate on the fixed coupon bond so that it too trades at par. The coupon rate on the fixed coupon bond is the fixed rate. Okay, that's probably more than you need to know for the level 1 syllabus. Right, okay, so yes, there you go. So it was obtained through the process of replication. The value of a swap is 0 at initiation and then fluctuates over the life of the contract. Remember, the fixed coupon bond and the floating rate note will only trade at par at initiation. After initiation, interest rates will start to change, and therefore the bond will be trading at different prices. Good. Okay, value of the swap is equal to present value of the fixed payments from the swap. Well, no, remember, if we were trying to value a long swap, pay fixed, receive floating, then we would look at the present value of what you're receiving, present value of floating payments, and compare them to the present value of fixed payments. And that would give us the value of our long interest rate swap. Okay, short interest rate swap, just swap them over. You're receiving fixed and paying floating. So it's present value of fixed minus present value of floating. So remember, of course, they're only equal to each other at initiation. They will differ after initiation. So it's partially true, isn't it? We do look at the present value of the fixed payments, but actually we compare it to the present value of the floating payments, and we're missing that part. So A is not true. The present value of the net cash flow payments from the swap, yes. Present value of floating minus present value of fixed, that looks like true. Underlying at the end of the contract, well, actually the underlying at the end of a contract is irrelevant when you look at interest rate swaps, because if you think about them as bonds, the par value of the floating rate note is par, let's say $1,000, and the par value of the fixed coupon bond is $1,000. The par value is the same on the floating and the fixed coupon bonds, so therefore they just offset, so that's irrelevant. So it's therefore the present value of the net cash flow payments from the swap. Okay. Right, oh good, we turn our attention to looking at options. Now I think options are a little bit more tricky because there are 4 potential positions you now need to consider. And we've got a call option here and a put option. Let's start with our definition. If you purchase a call option, then you are buying the right, but not obligation, to buy the underlying asset for the strike price on the option at a fixed future date. Okay, so this X is known as our strike price. And it's the price you're locking in to pay in return for receiving the underlying asset in the future. Okay, but notice it's only a right to buy. The long party with the call option does not have to buy the underlying asset and pay the strike price. Okay, they're only therefore going to do it if it is in their interest. And if it's in the long party's interest, then it's, of course, it's working against the short party. So again, we're really looking at this from a long party position here. So long call gives you the right to buy the underlying asset and pay the strike price. Strike price, often also called exercise price. You should use those interchangeably. Put option, if you go long a put option, then you've got the right to sell the underlying asset for price, the strike price. In other words, with a put option, you can sell the underlying asset and receive the strike price. Let's just think about all of our positions on options. Let's get my blank screen up again. Okay, so let's think about the call first of all. So the long party has the right to buy the underlying asset and pay the strike price. Okay, now, logically speaking, let's imagine the underlying asset's a stock. You will only exercise that if the stock price is greater than the strike price. In other words, I'm going to only exercise my right to buy if what I'm buying is worth more than what I'm paying. And remember, you are paying the strike price. Okay. So what about the short party on a call option? The short has a potential obligation to sell the underlying asset. Okay. Now, in other words, if the long party exercises their right to buy and pay the strike price, then the short party is going to have to sell and receive the strike price. Key point is the long party only ever exercises this when the long party makes a profit. And if the long party is making a profit, the short party is making a loss. Now, you might therefore ask yourself, what is therefore the incentive to be the short party if you're only ever going to make potentially zero or a loss? Well, the short party receives a price. In other words, they are selling the right to buy, and when they sell the right to buy, they receive a price for that, known as the option premium, and they keep that come what may. So long party is the right to buy the underlying asset, short party potential obligation to sell the underlying asset if the long party exercises their right. Put option, long party has got the right to sell the underlying asset at the strike price. And again, in this situation, you're only going to want to sell the underlying asset and receive the strike price if what you're going to receive is greater than the value of what you're selling. So if the strike price is greater than the stock price, they will exercise their right to sell. Now, therefore, from the short party's point of view, they have a potential obligation to buy the underlying asset. And of course, they'll only have to buy the underlying asset if the long party exercises their right to sell, and the long party only exercises their right to sell if it's profitable for the long party, and if it's profitable for the long party, then the short party would be making a loss. So again, short party will receive a payment up front known as the option premium to offset some of their risk, essentially. So in terms of remembering call options, so from the long party, call gives you the option to buy. C and B close to each other in the alphabet, and P and S close to each other in the alphabet. I used to say it's all about dogs. There are two ways to get a dog. Either you can sneak into a park and call the nearest dog towards you and then run off, or alternatively, you could go to a pet shop and buy one. So calling and buying dogs, you end up with a dog. There are two ways of getting rid of a dog. You could sell it on to somebody else, or you could have it put down. So put and sell. Don't know, maybe it helps you. Maybe this was obvious in the first place anyway, but you can think about it in terms of dogs from the long party's point of view. Right, let's flick back to our slide then. Good. In the money, out at the money, out of the money. So in the money, out of the money, at the money. It's all to do whether the option currently has a payoff. Now, for a call option, you're receiving the stock or the underlying asset and you're paying the strike price. So in other words, if the stock price is greater than the strike price, then it's in the money. So if it currently has a payoff, it's in the money. If it's out of the money, for a call option, it must be because the value of the underlying asset is less than the strike price. In other words, the value of the underlying asset is less than you would have to pay to purchase it, and therefore you would walk away. Okay. So, in other words, stock is lower than strike. And at the money is a curious scenario where stock minus strike equals 0. I actually prefer to do this slightly differently. My in the money, out of the money, at the money. It's all true what they've got on this slide, and it's how they've written it in the Institute's material. I haven't happened to dislike it though. This is how I do it. You can ignore this if you want. But when I'm thinking about it, for a call option, I do call and put. Okay, so let's do in the money. ITM. For a call option, it's if currently it would have a payoff if you were to exercise it. Whether you can exercise it or not, let's ignore that for a second. But if you could exercise it right at this current point in time, would it have a profit? In other words, is the stock price currently greater than the strike price? If it is, then your call option is in the money. Now, for a put option, it's going to be the other way around, and we tend to look at payoffs on put options by writing strike. And this time, we want the strike price, what you would receive when you sell it, to be greater than the stock price. Okay. So for call options, they are in the money if the value of the underlying asset is greater than the strike price, and for put options, they are in the money if the value of the underlying asset is less than the strike price. Out of the money is just going to be the opposite way around, OTM. So stock price less than strike price, in which case with your call option, the option lapse is worthless. You'd never exercise it in that scenario. You'd never want to pay more than the current value of the underlying asset. And for a put option, it must be that the strike is less than the stock. Again, I would never want to sell an underlying asset for less than its current value. And remember, at the money is just the strange scenario where stock and strike are currently at the same value. They have a little bit of a significance to time value because time value is maximized when the option is at the money. But we'll see more of that in the level 2 syllabus. So that's how I prefer to do that. So when you're looking at moneyness, just currently, all you need to do in the exam is say, would I exercise the option if I could? If the answer is yes, it's in the money. And if the answer is no, it's not in the money. So the exercise price is X, the underlying price is S. Options can be European or American. Let's have a quick look at this. This has got nothing to do with where they are traded. Okay, it's just the name we have for the options. So a European option, significance of this is it can only be exercised at the expiration of the option. In other words, the long party only gets to choose whether they're going to exercise their right at the expiry date of the option. With an American option, the long party can choose to exercise at any point up to expiry. So there's more flexibility with American options because you can exercise at any point up to expiry. And that must mean the value of an American option has to be at least as big as a European option, if not higher. American options can't be worth less than European options because they have this greater flexibility. Okay, so notice American options are worth at least as much as European options because they have the possibility of early exercise. Now, in reality, it's very unlikely that options are exercised early. Why? Because when you buy or sell an option, the premium that you pay is made up of intrinsic and time value. Okay, if you exercise an option, you just get the option's payoff, which is its intrinsic value at that point in time. So if you exercise an option early, you would actually lose the time value. So rather than exercising an option early, it's normally, if you want out, it's best to sell it on to another party. So it's very, very, very unlikely you will exercise call options early, because if you do, you lose the time value. Now notice there is an exception for that, and that's when the underlying asset is going to pay a dividend or interest. So you might want to exercise your right to buy so that you hold the share or the bond so that you receive the cash flow. Okay, so that might be the scenario where you want to exercise a call option early. But other than that, no, never exercise calls early. It's better to sell them on. Now, exercise put option, again, typically they are not exercised early, but there is an exception, and that is if they are deep in the money, meaning they are virtually guaranteed to expire in the money. Why might we want to exercise it early? Because if we exercised it early, in other words, remember, when we're looking at put options, we're selling an underlying asset. If you exercise it early, you get the cash now, and then you could reinvest that cash, okay? Whereas if you hold it all the way through to maturity, you are losing the cash that you could have received on reinvestment of the proceeds. So really, exercising a put option early is about getting the proceeds so that you can reinvest. Now, our option premiums. Our premiums are made up of two elements. Our option premium is made up of intrinsic value and time value. Intrinsic value can be positive or zero. Okay, intrinsic value can never be negative. Negative intrinsic value infers you let the option lapse. So notice a call option, intrinsic value is stock minus strike. Okay, it could be positive, but it cannot be negative. Negative would infer that the stock price is below the strike price, so you wouldn't exercise your right to buy. Okay, it's called intrinsic value. If you hold the option to expiry, then we often refer to it as the option payoff. Okay, so it's called the option payoff at expiry. It's called intrinsic value prior to expiry. And for a call option, the intrinsic value is stock minus strike. Okay, and for put options, the intrinsic value is strike minus stock. And remember, intrinsic value is either zero or positive. It can never be negative, because you would if it was negative, it just infers you would not exercise the option. Now, of course, if you don't exercise the option, then you lose the premium that you've paid. Time value. Now, this is the reward for the short party due to uncertainty. In other words, the idea that the underlying asset can vary over time up until expiry. So what they're getting when they sell the option is the current intrinsic value, which would be the payoff if the option was exercised immediately. Okay, and then the time value is their risk for uncertainty. So time value is really driven by volatility and time to expiry. The risk-free rate has an effect as well, but not massively. Those are the two big ones, volatility and time to expiry. More volatility in the underlying asset, then of course the bigger the risk to the party that is selling the option, because that underlying asset is going to fluctuate much more over time. Therefore, they could make much bigger losses. And remember, the only gain to a short party is what they're doing is they're selling the right, and they're hoping the option expires out of the money so that they get to keep the premium. And that's their only reward, okay, keeping the premium. However, the downside potential is the massive payoffs, the intrinsic value that they might have to pay out if the option is in the money. So they've got the risk that the underlying asset may increase the option's payoff over time, and they want reward for that, and that is therefore factored into time value. Now, we will look essentially how you calculate option premiums from basics using a binomial model in just a little while. Here, typically, they're going to tell you what the option premium is. You then have to calculate the payoff on the option, take the premium, deduct the payoff, and what you're left with is time value. Good. Oh, we've got a question. The profit on a 35 call option purchased for $5 when the stock price at expiration is 45 is. Okay, so we've got to work out the profit on a European call option. Now, essentially, first of all, to work out the payoff is simply stock price at expiration minus the strike price. Okay, so for this case, stock price at expiration is 45. Strike price is 35. So the option has a payoff of $10. Now that's payoff. That's not the same as profit. When you're looking at profit, what you've got to do is take the payoff at when the option is exercised, in this case at expiration, take the payoff at expiration, and then deduct the premium that the long party has paid. And our long party has paid $5. So essentially, profit equals payoff minus premium paid, $10 minus $5. So 10 minus 5 gives us an answer of A here. Okay, call is in the money. Profit is payoff minus premium, 10 minus 5, giving us 5. You might want to sketch these as well if you're into sketching them. And I think this is often quite a nice idea whilst you're getting to grips with options. Sometimes it's helpful to sketch. Let me just sketch what this would look like. Okay, so I'm going to put price on this axis. I'm going to label up the strike price. Our strike price here was $35. Okay. Now the basic idea is the payoff. I'll do it in, what color will I do it in? Let's do the profit. The profit, if the underlying asset is below the strike price, the long party lets the option lapse, in which case they have to write off the premium they paid, so minus $5. And that's going to be the case all the way until we get to the strike price. Once you get to the strike price, then they're going to start to exercise their option. Initially, that starts to minimize their losses. Imagine if the underlying asset was $37, okay, and we've got the right to buy, the strike is 35. So sell for 37, buy for 35, you made a $2 profit or a $2 payoff. Oh, then factor in the premium that you paid, $5, 2 minus 5, you'd make a $3 loss. But that is better than letting the option lapse and losing the full premium of $5. So first of all, we initially let the option lapse. And then essentially, once we go over $35, once the underlying asset moves over $35, you start to exercise. There's our break even. Break even on call options, therefore, is going to be your strike price plus the premium paid. In this case, 35 plus 5. So our break even is at 40. Imagine the underlying assets at 40. Underlying assets at 40, you've got the right to buy at 35. Okay, you make a $5 payoff and then deduct the premium of $5, you end up with 0. So notice therefore with our long call, notice therefore that it is a bullish strategy. You need the underlying assets to rise, and in fact you need it to rise above $40 before you'll start to make a profit on your strategy. Now, just like the futures market, the options market is a nil-sum game. So if this is our long position, I'm just going to put the short position on in red, and it's going to be a mirror image. So the short position, they're going to keep the premium if the long party doesn't exercise their right. And remember, the long party does not exercise their right if the underlying asset is below the strike price. Once we get to strike price, once the long party starts to exercise, initially their profit is going to decline until it hits the break even. And if the underlying asset is above the break even, then essentially they're going to make losses. Key point to note, notice those losses, they're uncapped. So it's quite risky to start selling call options, shorting call options, because you've got a capped upside. Best upside potential is keep the premium, but there is an unlimited downside here. So this is our short call position, and we would typically refer to a short call as being neutral to bearish. Why neutral? Well, notice their profit doesn't get any bigger as the underlying asset falls. Okay, it's capped at $5. So they don't really need a bearish market, but what they do need to do is to avoid a bullish market. Okay. Nice. Okay, so let's look at the next one. Ooh, a European call option and a European put option are written on the same underlying asset, and both options have the same expiration date and exercise price. At expiration, it is possible that both options will have negative values, the same value, or positive values. So let's think about it from the call option. In terms of payoffs, call payoff is stock minus strike, and the put payoff is strike minus stock. Now, there is no way, given these are the same strikes, so the strike is the same, and we're looking at the same stock here, there's no way both can be positive at the same time. Likewise, there's no way that both can be negative at the same time. So they can't both be in the money, and they can't both be out of the money. However, potentially they could have the same value if they are at the money. Because if they were at the money, let's say the stock price $35, the strike price $35, they would have a payoff of 0, and the same on the put option, 35 and 35, 0. So potentially they could both have the same value, but you can't have both being negative or both being positive. If the call option has a payoff, then the put option doesn't, and vice versa. Okay. Blimey, what does all this say? Let me remove the ink from the slide, see if we can read it. Oop. I think I can remove all of the ink in one. Oh. Sorry. There we go. If the underlying price at expiration equals the exercise price, both the call and put have values of 0. Okay, absolutely. They are at the money. Their payoff are 0, and therefore they both have the same value. The underlying has any other value. If the underlying has any other price, one of the options will have positive value, will be in the money, and the other will have a value of 0, i.e. it will be out of the money and it will lapse worthless. Good, lovely. Nice. Okay, at expiration, a European put option will be valuable if. Right, let's again, I think I'm going to draw this, and we'll talk about it as we draw the profile of a European put. So let's put our strike price on there. That's our strike price. Now, remember, with a put option, it is the right to sell at that price. So if my underlying asset is above the strike price, I'm not going to want to sell it and receive the lower strike price. So with the long position, it's going to expire out of the money, in which case I lose the premium I paid, all the way until we get to the strike price. Once the underlying asset goes below the strike price, then we will start to exercise. And this is our long put. Let's make up some values. Let's say our strike price equals $30. Okay, let's put that on as $30. And let's say the premium that we paid to acquire the option was $5. Okay. So as long as the strike price is above $30, you'll let the option lapse. Let's imagine the underlying assets trading at $40. Last thing I want to do as a long party is exercise my right to sell something that's worth $40 and only receive $30 for it. So I don't exercise it. But once the strike price goes below $30, I will start to exercise. Remember, if the long party does not exercise, they lose the premium of $5. So if the underlying asset, let's say, went to $28, I would now exercise my right to sell it for $30, because that would give me a $2 profit, Okay, therefore my overall loss would only be $3. Okay, remember, if I let the option lapse worthless, I lose my full $5 premium. However, if I exercise it, even if I don't make a profit, it will start to minimize a loss. We then have our break even here, and break even on put options is always the strike price minus the premium. So in this case, the break even is at $25. Imagine underlying asset falls to $25. I've got the long put option with a strike of 30. I could buy the underlying asset for $25, sell it by using my put option for $30, making a payoff of $5. And of course, that's equal to the premium that I paid, so no profit or loss. Likewise, the maximum profit you can ever make is also equal to your break even on a long put. Again, imagine the underlying asset is 0. I could buy it for nothing, sell it for $30. Okay, that would give me a $30 profit, deduct the premium paid, $5, and therefore overall my profit is $25. Good. Okay, so that is the long put. Short put, again, is going to be a mirror image of this. So it's going to go along here until we get to the strike, then going to kink down, they get across at the same point, and therefore the maximum loss they can make is $25. Remember, always a nil-sum game. So from the long party's point of view, this is very much a bearish strategy. You need the underlying asset to fall, need it to fall below the strike price, and in order to make a profit, you need it to fall below the break even. Okay, and the more it falls, the bigger your profit will be. So long put options, definitely a bearish strategy. However, our short put option, so our red, our short put option, again, we don't want the market to be bearish because that's when we start to make losses, but we don't need the market to be bullish because our profits don't get any bigger as the underlying asset rises. So we typically refer to the put option, the short put option, as being neutral to bearish. Okay, let's have a look. At expiration, a European put option will be valuable if the exercise price, well, we want our exercise price. Is it less than the underlying price? Now, we want the underlying price, don't we? We want our underlying price to be below the strike price. So we don't want the strike to be less than the underlying. We want it the other way around. So that's not right. Equal to the underlying price. Well, if it's equal to the, if the strike and the underlying price was equal, then actually, notice the long party would be here, and they would lose the premium. The payoff would be 0, and they'd lose their premium of $5. So that's not true. Make a $5 loss. We want the exercise price to be greater than the underlying price. In other words, the stop to be lower than the strike. Absolutely true. Okay. So good. Our answer was C for that one. Right, a little bit of derivative valuation then to finish us off on this presentation. How long have we got? We've got about 18 minutes, haven't we? Blimey, time has just flown past. Probably not for you, but it has for me. Okay, law of one price. If two assets or portfolios have the same future cash flows, regardless of future events, in which case they have the same risk, arbitrage will cause them to have the same price. Absolutely true. And actually, this is how we're going to price a lot of derivatives, by assuming two assets or portfolios that generate the same cash flows and have the same risk must have the same price. Yes, replication, position in the underlying asset hedged with the derivative is a risk-free asset. Yes, okay, so that's fine. Nothing particularly exciting by that. We use risk-neutral pricing to determine no arbitrage derivative prices. Yes, okay. So let's have a look at this. Derivatives price versus value. And actually what we're looking at here is futures and forward contracts. The no arbitrage price of a derivative gives it a value of 0 at initiation. Yeah, I think I really want to make a note that we're really looking at forwards, futures, and swaps when we look at this. Good. Right. Now, it says the no arbitrage forward price at initiation. Take the spot price today and compound it up at the risk-free rate up until the delivery date. And that will give you your zero arbitrage price for a very simple derivative. Okay, let's do an example of this. Let's put some numbers in. You won't be asked to do numbers in the exam, but I think it's a lot easier to understand, essentially, if you... Oops, what have I done? Hang on a sec. Press the wrong button on my computer. Ah, there we go. Hopefully, hopefully you can see my note page come up. Pen away. Come on. Sorry, I can't get my... Let me just escape out of this. Gosh. Okay, I'd run out of blank pages. That's why it wasn't letting me go any further. Right, let's just create another one. Right. Let's assume a very simple forward contract, and I'm going to assume it on a zero coupon bond. Significance of a zero coupon bond is there are no cash flows on it. So let's imagine that we've got a risk-free rate here of 5%, time to delivery half a year, okay, and my spot price of my zero coupon bond, so current price of my zero coupon bond, let's say, I don't know, $9.90. Okay. Actually, let's make it a little cheaper than that. Let's make it $9.60. Why not? There we go. There's my zero coupon bond. Now, from this information, I could work out the forward price for a forward on the zero coupon bond. So remember what a forward on the zero coupon bond would do is it would allow somebody to buy the zero coupon bond in this case, half a year's time and pay the forward price. So we're going to use this relationship. Forward price is equal to the spot price times 1 plus the risk-free rate compounded to maturity. So in this case, my forward price is equal to 960 times my risk-free rate to the power of half a year. And that's our answer. Let me just get my calculator out. Have a go at doing this. So 1.05 to the power of 0.5 times 960, and I get a bond that has a value of, a forward that has a price of 983.71. I'm going to round to the nearest 7. Okay, so in other words, if I was to sell a forward contract allowing somebody to buy this zero coupon bond in half a year, I would charge, or I would set the forward price at 983.71, and that would prevent any gain or loss. Okay, that is the zero arbitrage price. Okay, so let's call that zero arb price. Why is that the zero arbitrage price? Well, broadly speaking, any other price would allow us to create a profit without taking any risk. So let's start. Let's imagine that erroneously the forward price was slightly higher. Let's imagine we got a forward price here of, I don't know, 990. So let's say the forward price was 990. Now notice that forward price is too high. It's above the arbitrage free price, so therefore it's overvalued. And what do you want to do with overvalued contracts? Essentially, you want to sell them. So the way I'd make my arbitrage profit here, so today, what I would do is I would go short forward. I would short the forward contract. Now, by shorting a forward contract, that is making that I'm entering an agreement to deliver this zero coupon bond in half a year's time and receive 990 for it. Now, how do I make sure that I've got the zero coupon bond in half a year's time in order to deliver it? Well, what I'm going to do is I'm going to borrow at the risk-free rate. I'm going to borrow at the risk-free rate, and the amount I'm going to borrow is the current price of the zero coupon bond. So I'm going to borrow 960. And I'm going to use that borrowings to buy the zero coupon bond at 960. Okay, that's what's going to happen today. In half a year's time, remember that's the delivery date. So half a year's passed. And what happens? Half a year's time, I'm going to deliver the bond. And I deliver the bond, I receive the forward price. So I'm going to receive 990. Now what I need to do is take that 990 and pay off my borrowings. Now notice, if I borrowed 960 at the risk-free rate for half a year, the amount I'd need to pay back was 983.71. So I'm going to pay off my borrowings. So 990 minus my borrowings, which are now 983.71, and the difference is my arbitrage free profit. So I've made a 629 guaranteed profit by doing this. Now, of course, as soon as market participants, or more likely computer algorithms, spot this, they're going to start shorting the forward contract. So the supply of shorts willing to short the forward contract is going to increase, and that is going to, of course, start to drive down the forward price. At the same time, in order to arbitrage, not only are they shorting the forward contract, they're buying the zero coupon bond. So they're going to start to buy the zero coupon bond. So the forward price is decreasing. The spot price of the underlying is increasing until the arbitrage profit disappears, essentially. So therefore, to prevent any riskless arbitrage, the forward price has to equal 983.71. What about it being higher? Oh, sorry, lower than 983.71? Well, again, what we just did, this arbitrage here, is actually referred to as a cash and carry arbitrage. It's called cash and carry because you're borrowing cash, buying the underlying asset in the spot market, otherwise known as the cash market, and carrying it to delivery of the forward contract. So buying with cash and carrying to delivery. Now, if the forward price was lower, let's say our forward price here is 970. Now notice 970 here is lower than the arbitrage free price. So in other words, the forward price looks undervalued. What do you want to do with undervalued assets? Well, the answer is, hopefully, you want to buy them. So what we're going to do today is we're going to go long forward. We're going to buy the forward contract. Now, if we go long forward, we're agreeing to pay the forward price of 970 in half a year's time and receive the zero coupon bond. Now, here's where it becomes a little bit more abstract. What we're going to do is we're going to short sell the zero coupon bond, and we're going to receive 960, current price of the zero coupon bond, and then we're going to invest our 960 at the risk-free rate. Now, we are assuming here that short selling is free, which of course it isn't. You have to borrow stock from a stock borrowing and lending intermediary. But we're really assuming that it's free. Okay, what happens in half a year? So half a year rolls round. Remember, we've gone long forward, so we're going to have to take delivery of our bond. And when we take delivery of the bond, we pay 970. Okay, so we're going to receive bond. Oops. Receive bond And when we receive the bond, we're going to have to pay. Let's put pay in there. 970. How do we get the cash to pay for this 970? Well, we, of course, we realize our investment. Remember, we invested 960 at the risk-free rate. So our risk-free investment, which we're going to cash in, is worth 983.71. And then, of course, what we do with the bond that we received, we use it to close out our short position. And notice here, essentially, we've paid 970, received 983.71. So we've received 983.71, paid 970, and therefore made a profit of 13.71 on the transaction. Now, this is actually known as a reverse cash and carry. And of course, maybe unrealistic because we didn't introduce any transaction costs. When you introduce transaction costs, it just means the forward price needs to move enough away from the zero arbitrage price that the arbitrage covers all of the transaction costs as well. Okay. But again, you're not going to be asked to do computations. I just wanted to show you cash and carry and reverse cash and carry simply because you understand that. You understand this relationship. Okay. So with no carrying costs or benefits, the forward price, F0T they're calling it, in other words, the price paid at time T, capital letter, just means at delivery, is today's spot price of the underlying asset compounded up into expiry. Now, what about, I had a zero coupon bond and I had it very specifically because they don't generate any cash flows. What happens if it was a coupon paying bond or a share? Well, of course, with those, buying them today and holding them to delivery, they can generate benefits. And those benefits would be dividends if it's a share, or interest or coupon, if you like, if it's a bond. And any benefits you receive will reduce the forward price because they reduce the cost of buying the underlying asset and holding it to maturity. So notice, once you introduce carrying costs and benefits, take the spot price today, add on the present value of any costs, subtract the present value of any benefits, and then compound them up to expiry. Again, let's just I find people struggle with this concept, so let's just do another little example. That was numerical, but let's just do a kind of let's pretend example. Let's pretend we're the kind of crazy guys that hold orange juice parties. Woohoo. And I'm going to invite you to my orange juice party. In 3 months' time. Kind of crazy guys we are. Now, how can I guarantee that I have orange juice in 3 months' time? Number one, I could go out and go long 3 month orange juice forward. Okay, and then of course in 3 months' time, up rocks the orange juice, I pay the forward price, and I have my orange juice, and we can party hard. Alternative, what I could do is I could buy orange juice today, okay, and pay that price. But if I just leave my orange juice sitting around, in 3 months' time, it's going to turn green. It's going to be rather moldy and undrinkable. So I'm going to have some costs of carrying. I'm going to have to refrigerate. Maybe I want to insure it against losses. And of course, another cost that I'm incurring here is if I bought the orange juice today, that means money's left my account, meaning, of course, there's an opportunity cost there. If If I hadn't bought the orange juice today, that money could have been earning the risk-free rate. So the other impact is my lost risk-free interest. Add those together and you've got the total price of buying orange juice today and holding it for 3 months. Now, the basic rule, therefore, is the forward price and this price have to be the same, okay, to prevent that arbitrage that we saw on the previous slide. So notice any costs of carry are actually increasing the forward price, okay, because the forward price is the spot price plus the cost of carry plus that lost interest. Now, if you were looking at something that generates benefits whilst you hold it, and of course the classic example of that would be bonds and shares, because they pay out cash flows. Any benefit you get from buying today and holding to maturity, those reduce the forward price. Okay, so hopefully that kind of makes that previous slide that we were looking at a bit more. Hopefully it makes this make a little bit more sense. So look, the forward price is equal to the spot price plus the present value of any costs of carry minus the present value of any benefits of carry, and then we're just compounding it all up until the maturity date. But I want you to take away from this, any costs you incur if you were to buy the asset today and hold to maturity, that will increase the forward price. Any benefits you get from buying the underlying asset and holding it to maturity, that will decrease the futures price. Okay, now we've also got the value to the long party here. Okay, before we jump into that, I just want to make it a little bit more simple. So we just saw that the forward price is equal to the spot price compounded up at the risk-free rate until the maturity of the contract. Now, therefore, the value at any point in time, to get the value of a forward contract, we compare the forward price, well, actually, we compare the spot price at the current date to the present value of the forward price. Now, if you think about it, ST just means the current value of the stock price at your valuation date. But you can't compare the forward price to the stock price at our valuation date because the forward price is only paid out at maturity. So what I've got to do is take that forward price and discount it from the maturity of my contract back to my valuation date. Okay. So for a very simple contract, therefore, the value is always going to be equal to the stock price minus, how did I say equal there? I meant to say minus the futures price discounted at my risk-free rate from maturity back to my valuation date. So we're always comparing current value of the underlying asset to the present value of the forward price. Present value of the forward price at maturity discounted back to your valuation date. Okay, I can't simply compare current value of the underlying asset to the forward price because the forward price is not paid until maturity. I'm not comparing like we like. So I've got to take my forward price and I've got to discount it back from maturity to today's date. Okay, that's your basic computation. Now, all then they're going to do is introduce a few complications, such as costs of carry and benefits of carry. Well, then all that happens is our value is the stock price minus the present value of any costs of carry plus the present value of any benefits and compare that to the forward price over 1 plus the risk-free rate. Okay, fair enough, and we've got that on our slide, so let's just go check that out on our slide. Okay, so notice, take the stock price at the current valuation date, add on the present values of any costs, subtract the present value of any benefits, and then compare that to the forward price discounted back to today's date. Nice. Okay, swap price, we mentioned this, and FRA price is just always the fixed rate. We mentioned that earlier. Let's have a look at a couple of questions. Then we've got a binomial slide to cover, and then we are done and dusted. Okay, at the initiation of a forward contract on an asset that neither receives benefits nor incurs carrying costs. Okay, so no costs or benefits of carry. During the term of the contract, the forward price is equal to. Okay, well, in this case, our forward price is equal to the spot price, current price of the underlying asset, compounded up at the risk-free rate until the maturity or delivery date of the contract. So the future value, not the spot price, okay, spot price is a component, but we've got to compound it up. Future value of the spot price, that seems quite good, okay. Present value of the spot price, well, if I said, what is the present value of some, let's say an orange that you can buy today costs you 50 cents. What is the present value of that? Well, 50 cents. The spot price is a present value. Okay, so that's nonsense. So it should be B that lights up, and indeed it is. Stocks BWQ and ZER are each currently priced at $100 per share. Over the next year, stock BWQ is expected to generate significant benefits, whereas stock ZER is not expected to generate any benefits. There are no carrying costs associated with holding either stock over the next year. Compared with ZER, the 1 year forward price of BWQ is most likely. Okay, remember, we get our forward price in this situation by taking the stock price minus the present value of any benefits, and then compounding them both up at the risk-free rate until maturity. So the stock price, okay, is the same for both of them, but notice that benefits essentially reduce this value. So benefits are going to reduce the forward price. So BWQ is going to generate benefits. So if these benefits are higher, the forward price is going to be lower. So our answer should be A. There you go. Just remove my ink. There you go. So forward price is stock price plus the present value of any costs minus the present value of any benefits, compounded up to the expiry date. Okay. So again, all I want you to take in there is benefits reduce the forward price, costs increase the forward price. Right, if the present value of storage costs exceeds the present value of its convenience yield is for commodities. It's the convenience of holding an underlying asset. It's typically for assets, underlying assets that are in short supply that you use in your production process. So by holding the underlying asset, it guarantees you don't run out of the underlying asset and have to shut down your production. Okay, and that benefit, therefore, of not having to shut down production is referred to as a convenience yield on a commodity. But notice storage cost is greater. Okay, so overall, that's going to force the forward price upwards. Okay, upper. Remember, costs increase forward price, benefits decrease. So overall, this is going to be an upward effect. So the commodities forward price, is it going to be less than the spot price compounded at the risk-free rate? No, it's going to be more. The only way it could be less than the spot price compounded at the risk-free rate is if you had a massive benefit, a massive convenience yield in this case. The same as the spot price compounded at the risk-free rate? No, it's going to be higher because, remember, if you take the spot price compounded at the risk-free rate, so we've been doing, take the stock price minus the present value of costs, sorry, benefits, I should say, plus the present value of costs. Take that amount, compound it up at the risk-free rate, up to maturity to get your forward price. Now, actually, that's the same as saying take the spot price today, compound that up to maturity, and then subtract the future value of any benefits and add the future value of any costs that you incur. Okay, mathematically, those two relationships are identical. Okay, so you can set your forward price using either of these and you'll come up with exactly the same value. So because our costs here are greater than our benefits, it means our forward price is going to be overall bigger than the spot price plus 1 plus the risk-free rate compounded to maturity. So therefore, our answer has to be C. And there it is. Lovely. Okay, an asset priced at S0 has a positive convenience yield. That's a benefit, so that will reduce the forward price. No storage cost or cash flows. The price of a 1-year forward contract on this asset at initiation. Well, again, remember, we could either say it's got a convenience yield here, so it's going to be take the stock price, compound it up to expiry, and subtract the future value of any benefits. Okay, and we've got positive benefits there in the convenience yield, the convenience of having this underlying asset hanging around. So what's that going to do? Well, that's going to drive the forward price down. So price of a forward contract on this asset is 0. Well, that's just nonsense, isn't it? 0 forward prices. They're trying to get you confused with value. The value of a forward contract at initiation is 0. That's not the same as the price being equal to 0. Is the forward price going to be bigger than the spot price compounded to expiry? No. Okay, it would be if we overall had net costs, but we haven't. We've got benefits here. So therefore, because we're subtracting those benefits, answer is going to be C. Okay, so there you go. Right, a little bit on put call parity. I know we're a little bit over time. I'll try and wrap it up. How many slides have we got? Not too many. A little bit on put call parity and options. Before we do this, we've got exercise price. We've got the impact of the Greeks, basically. They don't call them the Greeks at level 1, but they are. Now, with exercise price, you're meant to tell how a change in exercise price changes the value of your option. All you need to do is think about your option payoffs. Let's say for a call option, stock minus strike, and for a put option, strike minus stock. Now, of course, okay, when we if we think about the exercise price, with a call option, a higher exercise price is going to give you a lower payoff, okay? Whereas for a put option, a higher exercise price gives you a bigger payoff. Okay, so that's all we need with that one. Price of the underlying asset, again, think about option payoffs. In other words, you call, stock minus strike, and you put strike minus stock. Okay, so here we're looking at the impact of the underlying asset. Higher stock price, bigger option payoff, so call premiums will rise. With a put option, higher stock price, smaller payoff, so the put premium will fall. Okay, so call values increase, put values decrease. Time to expiry. Well, with time to expiry, the basic rule is the longer the time to expiry, the greater the value of the option, because there is more time for that underlying asset to vary over time. There is that exception, European put option, heavily in the money with high interest rates, where it might well be worth exercising it now to get the cash and reinvest. Price volatility, well, again, rule here is more volatility, more risk to the short party, more risk to the seller of the option, and therefore the premium that they charge, remember that's paid by the long party at initiation of the option, will be higher to cover their risk. Okay, so more volatility, both call and put options will increase values. Risk-free rates increases call values, decreases put values. Well, it's really due to a mathematical equation that you won't see until you get to level 2. And if we use Black-Scholes-Merton, Black-Scholes-Merton takes essentially values a call option by taking the current value of the stock times something called ND1 and subtracts the strike price or present value of the strike price times N. See, I should have slightly changed how I've written that. ND1, that's ND2. Okay, now all you need to really think here is mathematically, if you've got a higher risk-free rate, the present value of the strike price will be lower. And even if you don't know what ND1 and ND2 is, and you don't need to know what it is until you get to level 2, that second term, this second term overall is smaller, then the option is going to have a bigger value. Okay, so therefore, an increase in the risk-free rate gives you higher call values. Now, when we look at put values using Black-Scholes-Merton, they are present value of the strike price times ND2 minus the stock price times ND1. And I don't want to get into D2s and D1s at the moment. We'll see them at level 2. All I want you to take away is, look, hang on, higher risk-free rate is going to mean overall this term comes down, and therefore the value of the put option falls. Whereas over here, higher risk-free rate gives you a lower value of the second term, meaning the value of the call option rises. Costs and benefits of holding the underlying. Yes, holding costs increase call values and decrease put values. Benefits the other way around, decrease call values and increase put values. Imagine a call option. Call option delays a purchase. Now, if that underlying asset was to pay a dividend and you hadn't purchased it, you wouldn't receive that dividend. So therefore, because call options delay purchases, if the underlying asset produces a cash flow, you miss out on that cash flow, and that reduces the value of your call option. Put options, however, delay sales. Okay, now, if you've delayed a sale and the underlying asset produces a cash flow, you do receive that underlying cash flow, which is a good thing. And therefore, that increases the value of your put option. Okay, now again, really, it's a mathematical relationship here. When you look at cash flows, it's rather like what we were doing with our futures. What you can do to adjust Black-Scholes-Merton to deal with cash flows is you can take the stock price and subtract the present value of any benefits and add the present value of any costs. And just replace stock price at time 0 with that. So benefits essentially are going to be bad news for call options, and costs are going to be good news for call options, and the opposite is true for put options. Good. Right, let's have a look at the last few questions we've got here. Which of the following is most likely to increase the value of a put option on a stock? Right, okay, so I would tend to start by setting out my intrinsic value, strike minus current value of the stock. And remember, the value of my option ultimately is intrinsic value plus time value. So if the stock price was to go up, so if this was higher, now that would give me less intrinsic value, and therefore my premium would be less. Risk-free rate. Okay, now remember what we said with this. With the risk-free rate, an increase in the risk-free rate essentially reduces the value of put options. Now, again, you can think about the put option as delaying a sale. Okay, so if interest rates are going up, risk-free rate is going up, do you want to delay sales? The answer is no. I want to make my sale now so I can reinvest at the higher risk-free rate. So essentially, you're losing that value. So it's not the risk-free rate. But again, remember, really, mathematically, it's because of the Black-Scholes formula, which is present value of strike times ND2 minus stock times ND1. ND2 and ND1 are probabilities. We'll talk more about those later on. So what do we know always increases value? Well, essentially volatility. Whether you're looking at call options or put options, volatility will always increase the value of your option. So the answer is C. If the risk-free rate increases, the value of an in-the-money European option will most likely. Okay, now I said we're looking at in-the-money European put option. Okay. So if the risk-free rate goes up, the issue essentially is, again, when we're looking at our put option, And of course, it's going to be decreased, as we've seen before. But when we look at it, when we look at our put option, we're looking at present value of the strike price times ND1 minus, sorry, ND2, I should say, minus the stock price times N, all over the place, ND2. Okay, so again, all you've got to say is if the risk-free rate goes up, if the risk-free rate goes up, present value of the strike price comes down, and therefore this term is going to be smaller. So it is going to be decrease. Okay, but as I often tell people, think about calls as delaying puts, calls as delaying purchases, puts as delaying sales. Interest rates are rising, a put option delays a sale. Is that attractive, delaying a sale when interest rates are rising? Answer is no. I'd rather make the sale today and then reinvest my proceeds at the higher risk-free rate. So therefore, put options delaying sales less attractive when interest rates are rising. Conversely, call options allowing you to delay a purchase, good news when interest rates are rising, because by delaying a purchase, you're able to reinvest at the higher risk-free rate. The value of a European put option can either be directly or inversely related to exercise price. Well, exercise price, value of a European put option, it's always, the intrinsic value component is always strike minus stock. So essentially, as the strike price goes up, you are getting greater value. So it is positively related to the strike price. It's never negative. It's not inversely related. So that's nonsense. Volatility of the underlying asset. That's an easy one. Always causes the value of an option to increase. More volatility, more risk for the writer, the short party, the seller of the option, and therefore they'll want a bigger premium when they sell that option to reward them. So our answer's got to be time to expiry, but it is a really tricky one because typically the longer time to expiry, the greater the value of the option. And that's true of calls and puts. The exception, though, is a put option that is heavily in the money. And remember, we said in that situation, you may want to exercise it now in order to receive the cash, okay, and then reinvest. So it's time to expiry. Right, we've got European put call parity, which we can blast through very quickly, and then a bit of binomial, so we're taking a little longer than I had hoped, but hopefully you're getting some value out of this. And if you do need to shove off early, don't worry, of course you can watch this all on video. Now, European put call parity says European call option plus present value of the strike price is equal to European put option plus the value of the stock. Okay. Now we can think of this, present value of the strike price, think of it as a zero coupon bond. It's a zero coupon bond that has a face value equal to the strike price, okay, and it will mature when the option matures. So think conceptually of a zero coupon bond. Now we tend to refer to this element, call option plus zero coupon bond, as a fiduciary call. Now the other part is long put, long stock, which is a protected put. If you own the stock and you buy a put option locking you into a guaranteed selling price, what you're actually doing is hedging against downside risk, which is where it gets the name protected put. Now for European options, and there's a few assumptions behind this, so we're looking at European options only, and we're looking at the same strike price on the put and call and the same time to maturity, then we can prove that the fiduciary call always has the same value as the protected put at expiry. Let's prove it. Two things that could happen at expiry. Either the stock price at expiry, the underlying price at expiry, is greater or equal to the strike price, or the stock price at expiry is less than or equal to the strike price. Okay, that's the only two things that could happen at maturity. And remember, you can only exercise European options at maturity. So let's think about our fiduciary call. I'm going to call it FID call. our fiduciary call. Two elements, the call option. For the call option, if the stock is greater than the strike price, does that have a value at expiry? It does, because stock minus strike gives us our option payoff. Okay, and that would be positive. So the call option has a positive payoff. The zero coupon bond, come what may, always pays out the strike price at maturity of the option. Remember, before maturity, it's the present value of the strike price. At maturity, the zero coupon bond is just going to be worth the strike price. Okay, that's our FID call. Let's look at our protective put. Now, our put option, payoff on our put option, well, our put option is out of the money. If the stock is greater than the strike, the payoff is zero. However, the other element of the protective put is the stock, and that will be worth whatever ST is. Now, notice what we've got. With the fiduciary call, we've got stock minus strike plus strike. Overall, the fiduciary call is worth the stock at expiry. The protective put option out of the money, stock is worth ST. Well, look at that. At expiry, both the fiduciary call and the protective put have the same value when the stock price is greater than the strike. What about the other way around? What about when the stock is lower than the strike? Well, if the stock is lower than the strike, call option expires worthless. So payoff zero, zero coupon bond, always worth the face value. So always worth the strike price. What about a protective put? Well, that's in the money, so it has a positive payoff. So strike minus stock. The stock is always worth the stock. Okay, so notice this portfolio has a combined value equal to the strike price. And this portfolio, strike minus stock plus stock, this also has a value equal to the strike price. So at maturity, the fiduciary call and the protective put have the same payoffs. Those two portfolios have the same values, come what may. If the stock's greater than the strike, both are equal to the value of the stock. And if the stock's less than the strike, both are equal to the value of the strike. Now, because they're European options and can only be exercised at expiry, if they have identical payoffs at expiry, they must have identical payoffs prior to expiry, which is why this relationship holds, okay, to prevent arbitrage. Good. Now, what you can then do is rearrange that equation to create your synthetics. And we'll have a quick look at that in just a second. So back to our slides. Oops, wrong slide. That's the one we want. There you go. So there you are. That's why put call parity holds. Okay. The cost of a fiduciary call must equal cost of protective put because they have identical payoffs at expiry and can only be exercised at expiry. So we're going to rearrange and get our synthetics now. Now, again, this is just simple algebra. So once you've got your European put call parity, call plus present value, there you go, there's present value of the strike price, equals put plus stock. Let's say I want to create a synthetic put option. All I'm going to need to do is deduct the stock price from both sides. So a synthetic put option is call plus, I'm just going to write PVX, present value of strike, minus stock, and that's equal to my put. Okay, now the way to interpret this is if you've got pluses, it means go long, and minuses, it goes short. So if I want to create a synthetic put, I need to go long call, long zero coupon bond, and short the stock, and I've created synthetic put. What about a synthetic call option? Well, this time I'd need to deduct the zero coupon bond from both sides. So call option, synthetic call is equal to stock plus put minus the present value of the zero coupon bond, present value of the strike price. So long stock, long put, short zero coupon bond, and I've got a synthetic call. And I can create synthetic stock as well, of course. Create a synthetic stock. All I've got to do is deduct the put option from both sides. So call plus present value of strike minus the put option, and that's equal to the stock. synthetic stock. And of course, I can create a synthetic zero coupon bond if I want, by deducting the call option from both sides. And those must hold for European options because of put call parity. And if they don't, you can arbitrage between the option and its synthetic. So we like a bit of put call parity. Last thing you've got on this particular slide is put call parity for forwards. Now, remember our basic forward contract relationship. We said the forward price is equal to the spot price compounded up at the risk-free rate maturity. We know with our put call parity that call plus present value of strike is equal to put plus stock. Now, if I want to do put call parity on forwards, so this is an option on a forward contract. Quite why they think this is important for a level 1 candidate to understand, I don't know, but they do. Okay. Now, look, there's my relationship here between the forward price and the spot price. So if I rearrange that, if I could say spot price is equal to forward price discounted by the risk-free rate and time t. Okay, now what that means is I can get rid of that and replace it with forward price over risk-free rate times t. Now this element here, I'm just going to rewrite that slightly. That is also strike price minus present value of the strike price, which is also the same. So call option plus present value of strike price equals put option plus present value of the forward price. Now, often I've then seen that rearranged one more time. What they do is they just subtract the forward price from both sides, and you end up essentially with call option plus strike minus forward price, both discounted, is equal to a synthetic put. Okay, so put call parity on forwards. There's the key. Just use your basic forward pricing relationship, rearrange it so you've got the spot price as a function of the forward price, and then put that in place of stock in your put call parity formula. Job done. Right, okay, based on put call parity, so I always just write it out. Call plus present value of the strike is equal to put plus the current value of the stock. There it is. A trader who combines a long asset, a long put, and a short call. Okay, so they're taking the short call across to the other side. So you've got PVX is equal to put plus stock, stock minus call. Okay, what are they doing? They are creating a long bond. Okay, so rearrange it. There you go. Cross to the other side. Oh, there you are. That's nice. And they've got a long bond. Beautiful. Right. So a synthetic. Synthetic put option can be created. Right. Synthetic put. Call plus present value of strike equals put plus stock. Need to get stock to the other side. So call plus present value of strike minus stock equals synthetic put. So long call, long zero coupon bond, short stock. So we need long call, short asset, yeah, short stock, and a long bond. It looks like our answer A is the correct one. Right, final slide. It is the final slide. Binomials. Don't need to know a lot about this, really. Very simple stuff here, but we will be using it heavily at level 2 to value options. Okay. So binomial, first came Black-Scholes-Merton, which is a continuous time model for valuing options. From that, then the binomial model was developed that uses discrete time rather than continuous time. So discrete discounting rather than continuous discounting. The benefit you get of using a binomial over Black-Scholes-Merton is it can value American options as well as European, whereas Black-Scholes-Merton can only deal with European. Right, what have we got here? So you've got the stock price today, $20, and we've then been told that size of an up move and size of a down move. Now, the size of an up move will be given to you in the exam. You do not need to worry about where it comes from. It is a function of volatility of the underlying asset and time. Okay, that drives the size of an up move. CFA Institute will never even tell you that. You'll have to just, okay, they just say the size of an up move is. So 1.25 simply means if the stock goes up, it goes up by 25%. Size of a down move, okay, so we've got a recombing binomial, meaning if you go up and then you have an up move in one period and a down move in the next, you end up back where you started. It means you can calculate the size of a down move as simply 1 over 1 plus the up move. So 1 over 1.25, so if the up move is 25%, 1 divided by 1.25, the down move comes out at 0.8. 80% chance of a down, a 0.8, so a 20% decrease in value. Now we then compute risk neutral probabilities. Now this is a formula again that will be with us at level 2. At level 1, we do not tell you what a risk neutral probability is. Okay, what we're doing here is somehow stripping out uncertainty so we can use the risk-free rate as our discount rate. These risk neutral probabilities are calculated from current prices. You don't need to worry about it. All you need to take away is this is not the actual probability of an up and a down move. There's no way you could know that, what the actual probability of an up and a down move is, because remember, when you value an option, you're looking at, you know, values of things moving in the future. If you knew what the probability of an up and a down move was, well, you could also work out maybe the probability of the Euro Millions draw or something like that. So it is not the true probability of an up and a down move. It's what we call a risk neutral. More on that at level 2. I'm not going to waste your time with it at level 1. However, you do need to be able to use this formula to work out the probability. So 1 plus the risk-free rate. In this case, we've been given a risk-free rate of 4%. 1.04 minus a down move, 0.8, over your up move, minus a down move. Okay, and the earlier you get familiar with this, the easier level 2 will become, because you'll be using it, as I said, in anger to value options at level 2. Okay, and that gives me 0.53 recurring. They've rounded it to 53%. So chance of an up move is 53%. Chance of a down move, therefore, is 47%. So our probabilities add up to 100. This is the binomial model. Stock prices can go up or down. They cannot remain the same. There is trinomial models. They're not in your syllabus. These would allow the stock price to stay the same. Now, what we can then use with our binomial, what we're going to do is use it to work out the value of the underlying asset at expiry. So $20 today, if it goes up by 25%. So $20 times 1.25 gives us a value in the up state of $25 and a value in the down state, so 20 times 0.8, and that gives us $16. Okay, so critically, we've now got the value of the underlying asset at expiry of the option. The significance of that is now we could take our strike price, and knowing the payoff on call options is stop minus strike, we can work out our payoffs. So 25 minus 15, okay, in the up mode, 25 minus 15 gives us our $10. In the down mode, what have we got there? 16 minus 15, and that gives us our value of 1. Okay, now all we're going to do is probability weight those payoffs. So remember, there's a 53% chance of a payoff of $10 and a 47% chance as a payoff of $1. So we're going to do 53% times $10, 47% times $1, and that gives us our expected payoff at expiry. Now, all you then need to do is take your expected payoff at expiry and discount it from expiry back to today's date. So there you go. There's our payoff at expiry, 577. Discounting it back, okay, one period at the risk-free rate, so 1.04, to get the present value of the expected payoff. And that is the option premium, or the value of the option. And in fact, all option pricing models do this. Even Black-Scholes-Merton, even though it might scare the willies out of you when you look at it level 2, all it's really doing is working out the present value of the expected payoff at expiry. That is how we price options. So 555, present value of the expected payoff at expiry. Lovely. Okay, so that is our binomial model. Level 2, we'll look at 2-period binomials. A couple of questions and then we are done. Which of the following is least likely to be required by the binomial option pricing model? Spot price. Now we need the spot price to work out the evolution over time. Notice we use that to work out the values here and here. So we definitely needed the stop price. 2 possible prices 1 period later. Yes, we're going to compute those. Okay, using take the spot price and multiply by 1 plus the up move and multiply by 1 plus the down move. Actual probabilities, no, not actual. We use risk neutral probabilities. They are not actual probabilities. They're stripping out risk, okay, because the problem is each investor has different attitudes to risk. So if you were to factor that in, everybody would have their own unique discount rates. Things get very messy very, very quickly. So by assuming risk neutral probability, it allows us to use a risk-free rate. But again, more of that at level 2. I don't want to bog you down too much, but they are not actual probabilities of up and down moves. In fact, there's no way of knowing what the actual probability of an up and down move would be without hindsight. Okay, so you can't have it with foresight. So it's got to be C. Indeed, it is. Based on the binomial model, an increase in the actual probability of an upward move in the underlying will result in the option price decreasing, remaining the same, or increasing. Well, if the actual probability of an upward move goes up, then of course it will increase. Oh, sorry. Oh, actual probability. I didn't read it properly. RFQ, read the something question, as we say. If we increase the risk neutral probability, it would increase the value of the option. Actual probability is not used, of course, in the formula, so it will have no impact. Okay. If we increase, let me just go back to this. If we increase the probability of an up move, significance is this value here would be higher, and you get an option, a higher value for your option. Notice this works. This binomial model works for call options. It works exactly the same for put options. If you're valuing a put, the only difference is how you work out the payoffs. So they would be strike minus stop, not stop minus strike. Good. And hopefully this is the last question. Assume a call option's strike price is initially equal to the price of its underlying asset. Okay, so strike is equal to price. Based on the binomial model, if the volatility of the underlying asset decreases, the lower of the 2 potential payoff values of the hedged portfolio. So to think about this. So we're saying volatility of the underlying asset decreases, but the lower of the 2 potential payoff values. Okay, and we are looking at a call option. So our payoff is stock minus strike. Okay, and they're equal initially, which must mean in the lower branch, because that looks at the underlying asset falling. Okay, the stock would be lower than the strike, and therefore the payoff would be 0. So it's not going to have any impact here. Initial value of the call is 0. Value of the call cannot be less than 0. So you change the volatility, it's going to remain the same. Still going to be 0. Lovely. Well done, guys. Goodness me, we overran by almost 3/4 of an hour. I won't charge you more. In fact, I'm not charging you at all. Dearie me. But thank you very much.
Thank you very much, Jonathan, for your constant support and outstanding support for our candidates here in the Netherlands. I'm sure they will put this to good use for the exams in May. And I'm very happy that you helped us out again here. We now have a trilogy on our website. We have the topic of portfolio management, fixed income, and derivatives. So I think that's a very interesting program already. And I'm sure our candidates will be able to put that to good use. Normally, I would present you now with a lovely box of chocolate or a bottle of wine, and it's growing every time, and I'm saving it up for you. And I hope that very soon we can do this live again because, well, I'm sure it's lovely to meet you again. So,
I better just quickly run through any questions that were asked. Somebody asked if the clearinghouse doesn't make any money because it pays back interest on initial margin, do they make their money from transaction costs? Essentially, derivatives participants have to pay the clearinghouse to be a member, so they get fees from all the parties there. Good. I don't think there was anything too much. Oh, there was one other question. Was 3 times 9 right on my Frars? Gosh, I don't know. I can't remember what the example was. I made it up. Let's have a look. Oh, it's the other. It's the other. Hang on a sec. Oh. This one, wasn't it? 3 times 9. I don't know. Okay, what was this? 3 times 5 Frars. So we had. Oh yes, sorry. So yeah, no, that was right. Was there another Frars I did? So 3 times Frars would expire at day 90. The Frars, which is what we've got here, and then the end of borrowing and lending would be 60 days later at 150. So that was right. Did I do anything else with Frars? I'm just confused because someone said 3 times 9. And so maybe I wrote it on the slide itself. Sorry, back to all the slides. See anything? So 3 times 9, I'll just tell you what 3 times 9 would be. 3 times 9 would be a Frars that expires at day 90, okay? And then the borrowing and lending is at the end of day 270. So it would be 180-day borrowing and lending from day 90 up to day 270, okay? And I don't think we covered that one, did we? Or maybe we did anyway. Oh, I went 3 times 8, and I should have said 3 times 9. Okay, thank you very much. Yes. So if it was a 180-day borrowing and lending, then indeed it should have been a 3 times 9. I do apologize. Fantastic. Thank you very much, guys. Thanks for listening. Goodbye.
Thank you very much, gentlemen. Have a lovely evening, everyone. And good luck with the exams.
Yes, good luck.